This is Seewing and welcome to another podcast. This time, you are going to learn some amazing information, and this is a tax masterclass of how to become a real estate professional status. Let's dive in, and there's such a powerful information for real estate investor. Here we go. The headline is Real Estate Investing Tax Benefits Professional Tax Status, REPS, REPS. I spend a lot of time not just putting this slideshow presentation together, but over the years, I spend a lot of time, although I'm not a licensed advisor, I spend a lot of time to put together this presentation. I hope you enjoy it. I hope you put a lot of value in this presentation. And ultimately, if you qualify, I challenge you to execute on your plan and then go from there. All right. So this presentation is for educational purposes only. Please consult your own licensed tax and financial advisors to go over your personal situation. But before I will talk about the great tax benefit, first and foremost, your priority should be to look at real estate property, investment property, as history's most powerful and proven multi-dimensional real estate asset class. It's the world's most tax-favored investment asset class, and in my opinion, is the world's greatest wealth-building investment vehicle. Why? Because you have four dimensions, aspects of benefits, which is cash flow, passive income, tax benefits, appreciation, equity growth, and using the power of leverage, using the power of a 30-year fixed rate loan for residential investing, 1 to 4 units. All right. So who should benefit from this particular podcast? I would say the ideal scenario for the REPS status. Again, I'm going to use this acronym quite a bit. REPS means real estate professional status. So if you're a high income earner, W-2 or business owner, if you made $150K, $300,000, $500,000 W-2, especially income, you could be doctor, lawyers, maybe not lawyers. I do not like to work with lawyers. Anyway, people paying business owners, highly compensated individuals who make six-figure income or more, and if you're in the highest federal tax bracket, around 37% or so. And if you live in a high tax states such as California or New Jersey or New York, then you can add on more taxes you have to pay to the states. All right. So real estate pro status. Ordinarily, by definition, when you own a rental property, all your rental losses, all your depreciation, all your negative cash flow at the end of the year are passive in nature. As a risk investor, it's a passive investment. And consequently, you cannot offset your passive losses against active income. That's the traditional methodology. However, if you qualify as a rep, you can use rental losses, paper loss, depreciation, or otherwise to potentially offset your active income. And that is a very significant. If you can offset your active income, you can potentially substantially reduce your income subject to ordinary taxation. And we can talk about that, right? So this makes qualifying as a rep extremely lucrative for real estate investors because most rentals produce tax losses thanks to depreciation and equity growth and debt pay down by the tenant, what have you, right? As I mentioned before, even when producing positive cash flow, you can still claim paper losses potentially against your active income, which is amazing benefit that IRS allow you to undertake. So here's the challenge you have to potentially go through. If you are single, most likely you cannot qualify as a real estate professional. So therefore, be prepared. You need to get out there and become or marry, quote unquote, a real estate professional, hopefully your spouse. If you marry someone and if your spouse is not working and maybe even perhaps a part-time working spouse, that is an ideal scenario. Why? Because the IRS want you to be rich. Wow, how cool is that? As long as you know the legal tax loopholes associated with being a real estate professional status, reps. Okay, when you hear the word reps throughout this presentation, you know what I'm talking about. Okay, here are the rules, section 469. I'm not going to go over that. Okay, to qualify as a reps, you must spend 750 hours or more per year in a real property trade or business and spend more time in real estate than anyone else. Now, this is very important definition, which I will clarify throughout this presentation. Thanks to number two, if you work full time and if you're single, guess what? You are SOL. But of course, I have a solution for you. As I said earlier on the slideshow, you need to have your spouse qualify. Okay, I have three ideas for you to qualify. Have your non-working spouse or a part-time spouse qualify while you continue to earn the huge income, hopefully, that you're earning. All right. So again, your spouse can qualify as a rep as long as he or she put in at least 750 hours per year, which is equate to approximately 15 hours per week on the real estate businesses. So this is a great strategy for high income earners also. Although if you earn less than what's my definition of high income earners, you can also partake on this reps strategy. Okay. So by owning real estate investment properties, you can funnel your W-2 earnings into it. Again, as I said, have your spouse self-manage some, but potentially not all of your rentals. Okay. I want you to fully understand what I'm trying to say. So in a year that your spouse can accumulate enough hours for the rep status, you may incorporate cost segregation and bonus depreciation into the process. I will explain that on this presentation. So consequently, enjoy your tax savings. Oh, please send me a thank you card. Important note, in order for this to work, your spouse must have a legitimate interest in real estate and wealth building. He or she, by managing rentals, is harder than it sounds, and no amount of tax savings is worth a divorce. Your significant other, both of you, must have a combined, both of you have to buy into the process, okay? You must buy into the process. Of course, I'm not gonna go over the technical details. You can digest this slideshow on your own when you pause the video. But of course, you have to substantiate. You have to use the correspondence log, the written log, whatever means necessary to justify your material participation hours, as I mentioned. Okay, and of course, again, technical aspects of qualifying as a rep status. You have to meet any number of the 7 material participation tests. And again, read on your own. And when you ultimately hire your licensed tax advisor, they will help you how to file the tax return, how to create this all-important sub-strategy. You have to select a aggregate election. Okay, don't worry about the technical terms. Okay, I'm teaching you high level, and everything else you will learn as you're doing it. Okay, as long as you surround yourself with a great financial team. Work to qualify for those related rules activities or the following, right? As you can see. Again, I'm not gonna go over all these kind of things, but because I have many more slides to show you. All right. All these things are part of the 15 hours per week, 750 hours per year. Again, making a group election, very important to check the box on your tax return and add a statement stating that you are a real estate professional status and you're making a group election. And when you file your federal 1040 on April 15th or later. Okay. So again, follow the rules, hire your trusted financial team, and you should be okay. Quickly, the simple calculation for depreciation, right? I'm using the example of this property here. This investment property actually is a fourplex, 545K. You deduct 20%. The land component is not deductible, so therefore you have to reduce the land component to determine the basis for depreciation. 545K minus 109 equals 436. 436K divided by 27 and a half years for residential investing, 1 to 4 units. But if you do a commercial, that's 39-year straight line depreciation. So just using straight line, regular traditional depreciation when you own an income property, 1 to 4 unit is 27 and a half years. So every year, for each year you continue to hold this property, you can get a paper write-off of almost $16,000 on this particular example. Okay. And of course, I would love you to incorporate the cost segregation into your plan because, again, you can choose the straight line, very slow depreciation on this schedule, 27 and a half years mostly, or when you pay to do an engineering study. By the way, most CPAs, they do not do cost segregation. I can refer you to a cost segregation engineering firm that's specializing in helping you to do this. So cost segregation will allow you to accelerate your structure, your building, that is, instead of a straight line 27 and a half years, certain component of your building structure, the house, the property, you can accelerate using 5 to 7 to 15 year acceleration method so you can get more upfront paper loss to offset against your active income if you qualify as a rep status. Okay. Again, I'm not going to talk about the cost segregation too much because I have a separate video. You can learn more about the nuts and bolts of the cost segregation. Suffice to say, anything that are not permanently attached to the structure, you can do a cost segregation acceleration, as you can see by this various write-off period. Okay, personal property is 5 to 7 year appreciation, and land improvement 15 years, and the rest of the structure of the property, which are permanently fixed to the structure, will stay at 27 and a half years. All right. And of course, this is a calculation. Again, I'm not going to go over too much of this, but on this example of this 545K fourplex, I do the calculation, instead of getting like $15,000 of straight line depreciation without cost segregation, if you apply the cost segregation, the total paper loss by doing a cost seg on this particular property is a whopping almost $30,000 that can give you some significant tax savings just on this one rental property. Imagine you can do more than one, which is ideal to maximize your tax benefit, especially when you have very high income once you qualify to become a rep status. Does that make sense? Hopefully. So the most important step that you can do your execution of your plan is that obviously the more paper write-off you have, the greater is your tax savings. You're very simple. So if you have the financial capacity to buy as many properties as possible, that will give you the paper loss to offset against your active income, right? That's the whole idea. So this presentation, I'm using the best case scenario, very high income scenario, and you can buy several multi-units so you can achieve maximum tax benefit using rep status. So therefore, the action plan would be for you to purchase and scale your real estate portfolio with multiple properties. How quickly you can buy is based on your goals and objectives and your ambition and your commitment and your capital requirements that you have to do this, right? So along the way, yes, do cost segregation and depreciation and even short-term rental tax loophole you can apply into your overall investment and tax strategy. Okay. And of course, I cannot talk about too much. I don't have time to talk about short-term rental tax loophole. I have another standalone video that will fully discuss the tax strategies associated with a short-term rental tax loophole. Okay. All right. So further, your action plan would be, regardless of where you live, potentially. Look, this action plan is just a sample case. There are some. This is not the only way to do it, but I'm just, again, I could only give you a sample case study. Okay, you can deviate however you want it when it comes down to executing on your plan. So potentially, one of your property you can buy in a local area requires a decent amount of rehab, and by buying a rental property local to where you live, you can manage the rehab top to bottom. I'm talking about the spouse, the non-working or part-time spouse that qualify as a real estate pro. He or she will be doing this kind of things, while the W-2 earning spouse will continue to earn your high income and fulfill your quality of lifestyle. So using this strategy enable you to accumulate the hours quickly. The minimum 15 hours per week, 750 hours per year. So of course, although this is a tax strategy presentation, the most important thing, as I mentioned to you, is buying real estate is by itself is a wealth building strategy. Anyway, is one of the best way to achieve wealth using real estate. So you can pair this strategy by using a grouping election, which I mentioned briefly earlier. So you can group all of your other rentals together into one activity for the purpose of material participation. What I mean by that? So this effectively enables you to work hard on one rental or more, maybe more than one sometimes, meet the hours test, 750-hour test, and enjoy the non-passive tax treatment on all your other rentals, even if they are managed by a third-party professional property manager. Make sense? So I'm giving you some practical solutions, come from real case study that I've done with our investors over the years. By the way, I have done the rules of professional status early on, 10 years ago. I've done that personally, so I know what I'm talking about. Plus, although I'm not a licensed tax advisor, I spend so much time and effort over the years to learn these strategies. Again, because I've been doing it for so long as a real estate investor and have guided a number of individuals along with my team of financial professionals, the licensed one as well, of course. So I help a number of individuals over the past few decades to use this real estate professional tax status to achieve your financial goals. Let's continue. So if you're unable or unwilling to buy a local rehab rental, consider allocating several quote unquote doors of your multi-units purchases for self-managing to achieve the necessary hours. And then the rest of your properties, you can delegate and outsource to a professional property manager, whether you buy long distance, passive, remote investment methodology, which I practice and my network and my investment club practice, buying, since most of us are living in California, a high cost area. Over the years, I've taken many real estate investors to buy out of state, long distance, almost passive investment methodology using professional property managers, so you can free up your time to achieve whatever lifestyle you're trying to achieve. And this is a real life example. I'm using this case study example. You buy a very good cash flow property in South Texas for $545K. You put 25% down payment. Okay, so in reality, you're getting some very nice monthly positive net cash flow. You're getting potential long-term appreciation and equity growth and debt pay down. by the tenant and all that. So all the returns are very documented, right? See all the metrics. You can study on your own. So these numbers are ideal scenario to jumpstart your real estate acquisition portfolio, so you can have higher depreciation to offset potentially against your active income. So these numbers are very good. I'm just showing you one example of a property. I will show you more, which is right here, right? So when you feel you qualify for the real estate professional status, if you do not have any kind of rentals to begin with, this is some of the recommendation I have for you to start ramping up your real estate purchases, assuming, of course, it's a big assumption that you have the down payment available to buy each of these rental properties. And because they're not cheap, because the minimum down payment to buy a multi-unit, 2 to 4 units in this situation is 25% down payment. So you look at the numbers, right? So this property is in Lawton, Oklahoma, brand new construction, a duplex for $315K. You put 25% down payment. The down payment is right here. You get the monthly cash flow, annual cash flow, and all the returning, all the numerical metrics. Study it on your own. Very highly desirable growth market in Lawton, Oklahoma. And of course, you can diversify your real estate portfolio by buying another fourplex, brand new fourplex in Florida, right? And put 25% down payment. Very good monthly positive cash flow, along with other high return situations per the information provided you. So digest this pro forma on your own to see the nice return of this particular portfolio of properties. You can potentially scale to maximize your rep status, tax status situation. And not too many real tax advisor through YouTube videos or podcasts or any other mediums, you're getting a deep dive as you're getting with me, because trust me, I took a lot of time to put together this presentation, because I incorporated the real tax return, which most podcasts do not show you, right? Most real licensed tax advisor, when they promote this type of tax strategies on YouTube videos or on podcasts, they do not do such a deep dive as I'm doing with you right now. So with that in mind, this rental tax schedule E, this case method is such that I have the 3 properties already listed right here, right? The fourplex in South Texas, the duplex in Lawton, Oklahoma, and the fourplex in Jacksonville, Florida. See, I plugged the number from the pro forma, which I already show you. All the numbers I plugged it in from those pro forma. And property A is that fourplex in Texas. Property B is a duplex in Oklahoma, and property C is the fourplex in Florida. So I just plug it in. Okay, I know it's just an illustration. These numbers are not precise, but I'm just trying to present this from a high level. All right, I just plug in the number from pro forma. As you can see, the gross rent. By the way, this gross rent, if you ignore the expenses and the depreciation on all the underlying debt obligations, this gross rent, by technical definition, is subject to ordinary taxation. So you could make the argument that this gross rent on an annual basis on these 3 rentals, if you're in a high tax bracket, as indicating on this case study, you could be in a 37% federal tax bracket if you earn $500K, as in the case of this presentation example, you're going to have to pay 37% federal and maybe 10% or more in a state income tax from the gross rent itself. So that's why it behooves you to have as much underlying rental expenses to offset the gross rent. So at the end of the day, you have very little income to report on paper, even though in reality, you're getting the real cash flow as indicated on the pro forma, and you're getting the real tax benefit and the real equity appreciation and the real debt pay down by the tenant. They're paying down your 30-year mortgage debt over time. So eventually your debt will be extinguished or substantial decrease over time, the next 5-10 years or more, so you can have more rental income, more passive income. That's the whole idea, right? Okay, so these rental expenses, as you can see right here, I'm not going to go over it, are pretty cut and dry, right? These are ordinary and necessary expenses associated with owning this type of rental property, as you can see right here. I'm not going to go everything. But if you use the cost, if you pay a firm to do the cost segregation on these three properties, and which you should, your approximate paper loss on using the cost segregation bonus depreciation is quite substantial, $29,000 on this particular calendar year on this property, and $21,000 on a duplex, and $60,000 paper loss on this fourplex in Jacksonville, Florida. So very substantial. If you do not, you can become a real estate professional status and not do the cost segregation. Why, I don't know, but your paper loss per property will be substantially lower than $29,000, the $21,000, $60,000. How much lower? Could be half, at least half lower without doing cost segregation. Okay, even if you do not do cost segregation or you forgot or whatever, it should not stop you from becoming a rep, real estate professional status in this case scenario. It's just that you will not get as many tax benefits as you would have had you done cost segregation. Does that make sense? All right. So as you can see by the numbers, the gross income minus all the regular expenses and the depreciation equals a paper loss of 25 grand on the first property, 15 grand on the second property, and negative paper loss of a whopping 55,000 on the third property. So these are passive losses. These three number of passive losses, if you're not a real estate professional, these passive losses can only limit by your passive income, right here. I say it again, if you're not a real estate professional tax status, you can only deduct $64,000 of expenses and depreciation to offset maximum $64,800 of your gross rent, right? You follow me? I hope you understand me. Because if you're not a real estate professional, however, if you make $100,000 or less, by definition, by the IRS rule, if you make 100 grand or less, you don't have to be a real estate professional status. You can deduct up to a maximum of $25,000 passive losses against your active income. So that's first category. If you make 100 grand or less, you can deduct up to $25,000 passive losses against your active income. However, the second category, by the way, I did a separate video on that, right? So check my YouTube channel. If you make more than 150 grand, if you're not a real estate professional, again, you can deduct all your passive losses to the extent of your passive income, which is your gross rent. If you make more than 150K, if you're not a real estate pro, you could only deduct the maximum passive losses to the extent of your passive income, which is the gross rent. If you exceed this, if your passive losses exceed your passive income, as indicated on here, if you make 150K or higher, if you're not a real estate pro, you have to, any excess passive losses will be carried forward into the subsequent year to potentially offset the passive income of the other property in the future years. Is that an ideal scenario? No. But this limitation is not that bad. You can still get tax benefit, but for future purposes, you're not going to get the current year benefit you can get if you meet the first requirement of 100 grand AGI, as is gross income or less. You can deduct 25K passive losses. And real estate pro, there are no limitation, right? If you make more than 150K, I say it again, I know I'm repeating this quite a few times, but it's not easy to digest this kind of technical information, although I'm trying to present it to you in a layman's term as much as possible, because I have the ability to present this in a layman's term by virtue of the fact that I'm not a technical person. I'm not a licensed tax advisor that I guess that will give you from a high level, explain this better than a real CPA. With their technical mumbo jumbo, they may not know how to explain this correctly. They can reference all the codes, all the technical words, very impressive presentation, but at the end of the day, a lot of people may not fully understand the way they present it with their legal tax jargon, if you will. So I'm doing my best to break it down my presentation in a layman's term, if you know what I'm saying. Again, if you qualify as a Risk Pro, in the case of this particular, the purpose of this video presentation, you see all this excess depreciation, 25 grand plus 15 grand plus 55 grand equal a total of 96,000, almost $100,000 passive losses. Okay, you got that? If you qualify as a pro, this entire 96,000 can offset against your adjusted gross income. That is the ultimate goal, right? That's the ultimate goal. All right, here's some more. So I took the liberty of showing the various tax returns. Again, most CPA, when they do this kind of presentation, they don't dive deep in a way that I'm diving deep with you by showing the details of the tax return itself. This income schedule, part one, schedule one, that means you carry forward from your schedule E, from the earlier example, that this tax form I show you right here, this is a schedule E, supplemental income schedule. This is a standard real estate tax form you have to file when you file your federal tax return, okay? Whether you hold it in an LLC does not matter, because LLC is a flow-through entity, is a disregarded entity. All the numbers, all the property, the income and expenses from your LLC or from your name, individual name, you hold this property in, does not matter, because the numbers are the same. The tax strategy are the same. Do you or do you not understand what I just said? The flow-through entity, you still have to report your gross rent. You still have to report your rental expenses. You still have to report your depreciation, okay? Sometimes the tax schedule may not be Schedule E. It could be a schedule something else. It could be a schedule subchapter S 1120 corporation. If you hold the property, which I do not recommend, but consult your tax advisors to what kind of entity you should hold, okay? But anyway, so almost 100 grand passive losses will be carried forward into part one, schedule one, line 5, which is right here. Rental real estate, since this is a negative loss on paper, is a passive loss, so I'll put a bracket right here to make sure it's a deducted against something. Oftentimes, if you do not know how to use tax strategies, or if you fail to write off depreciation, paper loss from your rental properties, or you fail to use the cost segregation status, you could be reporting a $96,000 rental property gain when you tax return. You have to pay more taxes on your ordinary tax bracket, right? It happens, right? Some people, for whatever reason, they own a large portfolio of real estate. They do not consult a legitimate tax advisor. They do not know how to plan ahead. They forget to write off depreciation. They don't know anything about cost segregation. And instead of getting this $96,000 paper loss to offset against your active income, this could be your gain, because the actuality is the property you're buying, as I told you, these 3 properties, you're making money. You're making this cash flow on a monthly, on an annual basis, is subject to ordinary taxation. As I mentioned earlier, if you do not know how to offset by ordinary and necessary expenses of running the rental property, in addition to depreciation, if you don't use this kind of strategy that I'm teaching you right now, you're going to pay a lot more taxes, even though a rental property itself should be an income-producing, high return on investment, as indicated on the metrics that you see here. Rent-to-value rate ratio, capitalization rate very high, cash and cash return very high. Total return on investment the first year is 28% in this case. Total ROI, okay? The real money coming into your pocket with the appreciation and the tax benefit and the annual net cash flow the first year is 28% total ROI in this property, okay? On your second property, the total ROI is 19% if you add on the annual net cash flow, annual projected appreciation rate at a mere 3% even, conservative rate, and the loan pay down and everything else. I'm not going to go over the formulas, but suffice to say, you can get almost 20% the first year return on your investment. What is your return on investment? Is your down payment. your down payment compare against your annualized return from all the multiple benefits associated with owning a rental property. Same thing here on this fourplex, right? This fourplex, you're earning monthly cash flow of almost $1,200 monthly, right? Okay. So in reality, you're collecting real passive income, real cash flow. You're collecting real equity appreciation on paper over time. And yet you're so smart. You watch my video, you digest this, you hire a financial team, you create a real estate professional status if you qualify. You use your cost segregation, bonus depreciation. So this 96 grand, almost 100 grand, guess what? Or furthermore, okay, let's say you own a primary home. Okay, you own a primary home and you get in your mortgage interest deducted. Yes, when you own a primary home, the mortgage interest you pay are deductible. It can reduce your income subject to adjusted gross income. So let's, in this case example, you pay $50,000 of mortgage interest. Okay, so your mortgage payment, principal, and interest is a little bit less than $5,000 a month. Okay, so you own a $1 million home in California. No big deal. The median price of a home is at least $1 million, depending on where you live in California. And I live in California for the past, San Francisco Bay Area for the past 33 years. So people have high primary home mortgage deduction. So this $50,000 of primary home mortgage deduction, when you Schedule A itemized deduction, can further reduce your income subject to ordinary taxation. So this $500K, your W-2 salary you're making right now, which is very good, right? You're living like a king, right? A lot of income, a lot of discretionary income, hopefully, to buy real estate. So minus $96,000. Again, assuming you qualify for the real estate professional status, so the 3 rental property, you have a total paper write-off of almost 100 grand. So $500,000 of total income from your W-2 minus almost 100 grand from your paper loss as a real estate pro status, rep status, equals your total income on line 9 of 403,000. You knock it down from 500K of income by 100 grand of passive losses to 403. But wait, there's more. I sound like an infomercial. Remember the $50,000 of primary home mortgage interest you pay for the year on my itemized deduction Schedule A? So you further reduce your 403K by 50,000 equals $351,000 of adjusted gross income, AGI. Okay, so far? So $351K of adjusted $353,000 adjusted gross income after those deductions. So I look at the tax table for 2023 tax table. So here it is. If your line 15, which is your AGI on your second page of the federal 1040, as I mentioned, is $353,441, just do the math. I took the liberty of showing this calculation. How cool is that, right? So I'm giving you such a great deep dive into this strategy. No one else out there in the YouTube world, CPA educator or whoever, giving you this kind of deep dive podcast. Thank you very much. Please, on your comment on the YouTube, please say thank you, Mr. Yi, for spending the time to put together this highly informative tax strategy with some practical case study situation. Okay, so comment below my YouTube channel or drop me a note. Thank you, Mr. Yi. This is powerful information. I'm saving you a whole bunch of money if you execute on this kind of plan, if this situation applies to you. And with that said, I look at the tax table. If you're earning 353 multiplied by 24% equals 84,000. And then you subtract by 13,200. So your total tax is 71,625. All right. So this is your tax bill after all those deductions if you qualify as a rep status. Does it make sense? So next question is, okay, so this is your page 2 of your federal 1040. So page 2 of your federal 1040, like I said, I carry down to line 24, which is 71,625. So the question is, on your W-2, federal tax withheld for the year, making $500K, what was your tax withholding, federal tax withholding? Is it more than, most likely it could be more than 71,000. So as a result, you most likely can get a refund. Okay. How much is the refund? Depending on your situation. What's your federal W-2 tax withheld status? Married, filing jointly, 3 exemption, 4 exemption, whatever. I don't know. I do not know the answer to your individual situation, which is right here. Federal tax withheld for the year on your W-2 earnings, deducted from your total tax you have to pay after all those huge deductions is $71,625. So whether it's a refund or tax due, if it is a tax due, that means you under withheld your W-2 for the year, right? So you didn't claim the right number of the exemptions, you didn't, whatever, okay? Yeah, I don't know your situation. But most likely, I have to assume, most likely, making $500K on this case example, that your initial federal tax withheld for the year on line 25A will most likely is higher at times, probably is much higher than 71,625 from total tax you're paying after all those great deductions on which I shared that with you. Okay, so I have to assume that your refund is pretty substantial. But again, it's a case-by-case basis. Okay, at the end of the day, let's recap this unique tax presentation. The recap is your primary goal and still and should be is to buy rentals for long-term wealth creation, generational wealth by buying rental properties. That's your primary goal, to get cash flow, passive income eventually so you can achieve retirement and get some equity growth over time, because real estate will always make you money over a 10-year cycle, regardless of any short-term volatility we may or may not experiencing currently in the current housing environment. Your secondary goal is to look at the tax benefit. Some of you qualify for real estate professional status. Some of you do not. Some of you can get, if you have a lower income, as I mentioned, you can qualify to get pretty decent passive losses. But if you make more than 150K or more, if you're not a rep status, you can still get tax benefit. It's just that you're not going to get the current year passive losses. The excess passive losses you can obtain will be suspended indefinitely for the future years to offset against other future passive income from your other rentals. So still could have some benefit, no matter what, right? So at the end of the day, you work with a trusted team of financial pros to guide you along. That's pretty much it. Of course, I do accept mentoring clients to become a rep status. I'm the main financial leader of my team as a real estate coach. I'm only a real estate licensed broker. I'm not a licensed tax advisor or a licensed financial advisor. But when an investor sign up with my program, because I've done real estate professional status in my previous career, I've done many things, and I studied tax strategies for many years, and I put together and I help a number of other investors to achieve the rep status over the past several decades. So we have experience, we have the process, the systems, procedures all in place. We have the network properties, the property I just showed you. We have teams available in those markets to supply you with these great properties in those locations. When you buy this turnkey cash flow properties, most of them are brand new construction. You use property management, so you can scale your portfolio very quickly, very easily. But it's a long-term buy and hold scenario. But so, yeah, we have the products, we have the properties for you to purchase, as many as you're capable financially to buy to get the higher paper loss depreciation to offset against your income. The whole 9 yards, we have the system in place, the whole team available to help you. Thank you so much. I know once you watch this video, digest it, you may have to watch more than once, most likely, because look, taxes are not easy to understand. I'm not asking you to be a tax expert. I'm just trying to help you based on your situation, based on your financial goals and objectives, and what tax strategies is appropriate to your situation. Again, with investing, buying rental property, you get all kind of multi-dimensional benefits, as I mentioned earlier. cash flow, passive income, increasing cash flow. You can raise your rent, and of course, tax benefits, equity appreciation, 3 to 5%, annualized return from a historical perspective, sometimes higher, sometimes lower. And of course, we do a 30-year fixed rate mortgage, amazing loan as an investor, especially for Fannie Mae lending guideline 1 to 4 units. You let the tenant pay down your loan for you over time, so you have more cash flow, more equity, more loan to value, whatever, and apply these amazing tax strategies. You can reduce your income substantially. The tax savings from using this type of tax strategy will allow you to buy more properties, for that matter, right? So multi-dimensional aspects. With that said, thank you so much for watching this video. Hope you received a lot of value from this video. If you did, please like and subscribe to my YouTube channel and comment below as well. And also subscribe to my email newsletter below on my website, so you can become a investor insider free of charge to become a member of our network, so you receive consistent free educational contents on real estate investing opportunities. All right, thank you so much. This is Seewing Yi. Have a nice time. Thank you so much. I'll see you on the next video. Bye-bye.